Hi class, in this video, I'm going to go over chapter 34, so the influence of monetary and fiscal policy on aggregate demand curve. So this chapter is very heavily based off the last chapter on aggregate supply and demand. So if you guys don't have any clear understanding or have any questions, I strongly encourage you to look at the last chapter first before you watch this video, okay? All right, so let's get started. So the aggregate demand aggregate supply curve, and we have this monetary and fiscal policy. So we mentioned briefly in the previous chapters about what the monetary policy is. Especially if you guys look back to your banking chapter, it mentioned about the monetary policy. That's when the Federal Reserve is actively using our money supply to influence our economic outcome. So let's look at this aggregate demand, little review from the last chapter. So aggregate demand curve is going downwards, so downward sloping, because three factors. So we have wealth effect, interest effect, and also exchange effect. Um, so for aggregate demand curve, remember there are four components for our aggregate demand curve. So we have the consumption, this over here, this consumption. We have investment over here, and then we have our net export over here. Now notice what's missing, that our government spending is missing, and that's because government spending is not influenced by our interest rate or the price level. So when the price level falls, quantity demanded for goods and services are increasing, and vice versa. When the price level increases, the quantity demand for goods and services will decrease. So just like our regular supply demand curve, for the aggregate demand curve, we see this inverse relationship between the price of the good. So now it's the overall price level in the economy, and how much is the real GDP that's being demanded in the economy, and that's because of the three effect over here. For wealth effect. So wealth effect is the least important, because when you look at how much our cash holding is in each individual household, it's really not that much, because for most consumers in America, for most households in America, majority of the wealth are all in terms of real asset, or in terms of stocks. So those tend to be insulated against any inflation impact. Um, but how much cash we have is very small. So whenever the price level increases, then according to wealth effect is that the cash in your hand become less valuable, because inflation is high, so you lose value on your cash. Therefore, you're going to buy less goods and services. So that is true, but because how little cash we have, so this is the least important factor in our aggregate demand curve. And then next is the exchange rate effect. So exchange rate effect deal with our import export. So whenever price level in America changes, that will change our import export. But because net export, which equals to your export minus import, so the combined effect of this net export is actually very, very small of the economy. And lastly, interest rate effect. So this is probably the most important factor that's influencing our shape of the aggregate demand curve, because how much the interest rate is can change and influence our consumption and investment big time. And especially when you think about especially when you think about consumers or business, when we try to expand our operations, build a new factory, hire new people, or for consumers, when we try to make some big purchases, we gotta borrow money, right? So how much money you can borrow depends on how much the interest rate is, and how much the interest rate change is can be influenced by our monetary policies, with their change of money supply. So this interest rate effect is the most important variable, most important factor in our aggregate demand curve. All right, so next, let's do a little review of our theory of liquidity. So this is mentioned in the two chapters ago. So interest rate will adjust to bring money supply and money demand together into balance. Now remember, when we look at the supply demand for money, so if you draw the supply demand diagram for money, demand is going downward, and then supply is upward sloping, and this intersection here, that is the value of money, and then the value of money is just the interest rate, right? So interest rate will adjust whenever the supply demand for money changes. And I also know the difference between our nominal interest rate and then real interest rate. So nominal interest rate, that's your interest rate pays you by the bank, or the interest rate on the paper. So the nominal interest rate has inflation built into it. And then real interest rate is your inflation adjusted interest rate. So the formula is actually very simple, that your nominal interest rate equals to your real interest rate plus inflation. And that equals to our nominal interest rate. Okay. And lastly, we're going to expect that our inflation expectation remain constant. Now, this one is actually very, very important. Now, we don't talk about this in this chapter, actually in this semester. But if you guys taking on the next econ class, not 2002, but the next like an intermediate econ class, we're going to talk about the inflation expectation. So what kind of impact that will have on the economy. And then sometimes when the consumers and business expect inflation in the future, that will change our current economic outcome. So that's a very important factor. But for now, we're going to assume the inflation expectation remain constant. So money supply, right? So where does the money come from? So for U.S. economy, the entire money supply is all controlled by our Federal Reserve, and then this is set up by our monetary policy. So it is fixed, and then because the Federal Reserve is not a profit um, driven entity, so whenever they're setting their money supply, they're only setting money supply based on the economy's need. So when you draw the money supply diagram, so again, money supply is perfectly vertical. I'm going to call this MS. That's because we are not changing this based on how much the interest rate is. We're only changing it based on how much the economy need is. All right, so, and also remember for this money supply, whenever the Federal Reserve change money supply, we're going to change this through our monetary policy. We learned this in the previous chapters. So this will be anytime we have, open market operations, anytime we have the reserve requirement, we have the change in discount rate. So all those variables, all those tools we can use to conduct our monetary policy and then change our money supply. The most widely used tool right now is our open market operation. So that's whenever the Federal Reserve is either actively buying or selling the government bond in the market. Okay, so that's one way how we can influence our money supply. If it's increasing, we're shifting to the right. Decreasing, we're shifting to the left. Next, for money demand, so this we're looking at the actual money here, the currency, the cash. So money demand, money is the most liquidable asset. Remember, to be liquidable, that means you can turn to your money into cash very quickly. So this would be everything in M1. So your currency, your cash, your checking account, your traveler check, those would be all part of M1. And also interest rate. So this is the value of money, right? So how much your money is worth. But interest rate is also the opportunity cost of holding on to the money. Because think about that, what are you giving up by holding on to the money? Then you are not earning any interest by the money you're holding on to, right? So that interest you must give up, and that is the opportunity cost of holding on to money. And then for our money demand curve, it is downward sloping. So this downward sloping shows that between so money demand curve downward sloping, um, and this shows an inverse relationship between the interest rate in the market and then the quantity demanded in the economy. Right. So if you have a very high interest rate, then consumer will demand less money. Very low interest rate, consumer borrow more money, and there's a higher money demand. So a negative correlation between our interest rate and then also the quantity of money demanded. So the action between our supply demand diagram, that's going to be the equilibrium in the money market. And then for this equilibrium, this is where the interest rate is in the economy. So interest rate is decided not by the government, it's influenced by the government, but it's actually decided between the intersection of supply and demand of the money market. And that equilibrium is called interest rate, right? So we don't call this price level anymore. We don't call this, the price of money. This is simply the interest rate. Okay. All right. So anytime if your market interest rate is above equilibrium, then the quantity of money people want to hold will be less than the quantity supplied. So that way, so same thing as our regular supply demand diagram. So when you have so we have our demand over here, supply over here. So that is our equilibrium. Let's call this E. Now, if your interest rate is currently higher, So at a higher interest rate. So what that would do, we're going to see a more quantity supply for money and lower demand for money, and that will be a surplus. And with a surplus of money, then this equilibrium, this interest rate will go down until you reach our equilibrium again, right? So the mechanic for this diagram is very similar to our supply demand curve, that anywhere you are away from that equilibrium, you tend to go to that equilibrium. So you will always go back to your original equilibrium of the interest rate. Same thing over here, we can skip. So that's what the diagram looks like. We already went over this. All right, so for our aggregate demand curve, it is downward sloping. So that means whenever there's a high price level, so when everything's getting more expensive, that means our consumers need more money to buy the same amount of goods and services. So everything getting more expensive, we're going to see a higher money demand. When you have a higher money demand, according to the diagram we saw before, when the demand for money is higher, so supply for money, demand for money. When the demand for money is higher, let's call this D2, we're going to see a higher interest rate in the economy. And at a higher interest rate economy, that just means it's more expensive for consumer and business to borrow money. And therefore, we're going to borrow less money to purchase the goods and services. So this transition here is very, very important, right? So higher price level, everything getting more expensive, then there will increase demand for money because we need to have more money to buy goods and services. Higher demand for money means more interest rate. More interest rate means lower consumption and lower investment. And that's why we see this negative slope aggregate demand curve between the price level and also aggregate and also our quantity output. So they are related to each other, and that's because the dynamic change of our aggregate demand diagram is based off our money market, right? So based off the interest rate in the economy. All right, so aggregate demand curve will shift whenever those four components change. So whenever you have the consumption, investment, government spending, and net export changes, those four components will shift our aggregate demand curve. And whenever they shift, that means your quantity of goods and services demanded economy change fundamentally at every single price level, right? So again, that's consumption, investment, government spending, and then net export. So whenever you have a change in the interest rate, that will shift this two a lot, consumption investment, and therefore your equity demand curve will be shifted whenever there's a change in interest rate. And then next, monetary policy. So monetary policy can either increase or decrease our money supply. So increase money supply means lower interest rate. Decrease money supply means higher interest rate. Right? So either lower or high interest rate that will have different impact on the economy, and it really depends on what the economic need is at the time. All right, so whenever the Federal Reserve increase money supply, so this we're shifting our supply curve to the right. So let's look at the diagram. We increase money supply, then we're gonna see our interest rate go down. So at a lower interest rate, our consumption will increase, investment will increase. That means our aggregate demand curve will be shifting to the right, right? So AD curve shifting to the right. And then vice versa, if the Federal Reserve decides to increase money supply. So decrease money supply, why not draw over here, okay? So you have decrease money supply. So if you look at the money market, supply demand, so supply goes down over here, then we're going to see this is R1, this is R2, a higher interest rate. A higher interest rate means lower consumption, lower investment, and then your AD curve is shifting to the left. Okay, so opposite effect of what we just showed. Okay, all right, so also know what's a federal funds rate. So we mentioned this in the earlier chapter. So federal funds rate is the interest rate bank charge each other when they borrow money from each other. So when we change our money supply, change our monetary policy, we try to influence how much the federal funds rate is, because how much the banks are paying for their interest rate when they borrow money from each other will also influence how much the consumers and business will pay for their interest rate on the loan they borrow from the banks, right? So the federal funds rate will impact our market interest rate. All right, so for the also remember what's the FOMC, that's the Federal Open Market Committee. So this guy's 12 members, 7 board of governors plus 5 of the 12 regional presidents. And remember, the New York Federal Reserve president is always there, because at the committee here, what they will do, they will meet once a month to decide on the direction of our monetary policy. And then whenever they try to either buy or sell government bond, so for all the open market operation, they're all conducted at the trading desk of our New York Federal Reserve branch, right? So that's why the New York president is always there. Okay, so again, what they will do here, they will try to conduct monetary policies by changing our money supply in the economy. All right, so we're gonna change our money supply. We can either try to increase our aggregate demand, or can try to decrease our aggregate demand. So whenever the economy is uh, in a recession, we're going to try to increase our aggregate demand by increase money supply and a lower interest rate, and then vice versa. If your economy is currently in inflation, and that is what the U.S. economy is currently in right now, we're going to try to decrease our aggregate demand, which means by decreasing the money supply and an increasing interest rate. All right, and I also know what's a liquidity trap. So liquidity trap is any time that if imagine your interest rate for the market is already close to 0%, right? So right now economy goes really, really bad. We're going through a recession. At the same time, we already have a close to 0% interest rate. Well, if that happens, that means there's not much we can do anymore, right? Because you can only go down, the interest rate can only go down um, to zero, that you cannot have a below zero interest rate, right? So this is called a liquidity trap, that when there already so much money in the economy, that whenever there's already so much liquidity in the economy and the economy is still doing pretty bad, then we have really no more tool to use, right? So aggregate demand, production, and employment can be trapped at a low level, even though we have very high liquidity, right? So that's why even though we can have a zero interest rate, but we don't want a zero interest rate, because with zero interest rate, that we might have a liquidity trap in the economy. I mean, so one scenario I always use in my class. So imagine how your parents use dessert as a reward for you to do something, right? So imagine that, let's say once in a while, your parents will buy you a double chocolate cake and says, hey, if you do your homework or if you wash dishes, then you can eat one slice of your double chocolate cake. That's great. That's incentive, right? But what if your parents give you a piece of the double chocolate cake every day? Right? And then the parent says, hey, if you do your homework, I would double your chocolate cake. Well, that's not as high as an incentive as before, right? Because now you already have chocolate cake, so you're already used to it. So it doesn't surprise you anymore. It doesn't incentivize you anymore. So same thing goes over here. So this low interest rate should be only used very wisely, right? Try to, appropriately incentivize our economy to go move to a certain direction. All right, so now, however, for our Federal Reserve, if we do get to this 0% interest rate, which we have in the recent economies, if you look at our last Great Recession, so 2008, 2009. So toward the end of the recession, we really try to use our interest rate, try to influence the economy. But toward the end of the recession, that we got really close to a 0% interest rate. So what else can we do? Well, there are two more tools. One is called a forward guidance. So forward guidance is when the Federal Reserve try to influence the inflation expectation in the market. Because if your consumer, investor, and business have a different expectation for the future inflation, that will change the current behavior, right? So we don't have to necessarily change the current market condition with our money supply, money demand. All we have to do is to change people's expectation, and that will change how they behave today. So imagine that right now we're already close to a 0% interest rate. and then our government says we're gonna keep this interest rate low for the next 5 years. And what that would do, that would incentivize our business to make more investment within the next 5 years because interest rate will stay low for the next 5 years. Okay, so that's called a forward guidance. And also something called quantitative easing. So quantitative easing, this is actually a very, very popular tool we had during the last recession. So this is when the government, the Federal Reserve, is actively buying out the long-term debt, the long-term loan that's in the hand of individual banks. And then the most important one that we have in this transaction here will be the mortgage, right? So for anybody here who has a house, or for anybody, if you know how your parents are buying houses in last years or last decade or so, look at which company they're borrowing money from, and then more than likely, really more than likely, that the money, the mortgage we pay now today is different. It's not the same company as the money we borrow from, because for those companies, what they would do, they would create this loan, lend the money to the homeowner, and then once everything's all set, they're gonna sell this loan to another company and get the money back. And then our Federal Reserve actually become a very active player in this market. They're actively buying off those mortgage from the bank's balance sheet. Now, in return, the banks will have additional cash to offer more lending, right? So that's called a quantitative easing. All right, so we talked about this already. So we talk about how it's bad. And next, let's talk about fiscal policy. So fiscal policy is how our government directly try to influence our overall economic outcome by using two tools. By using either our government spending or by using our taxation, right? So either one of this will impact our economy greatly. Now, for government spending, that's a direct change. For government spending, remember the aggregate demand curve, that's your C plus I plus G plus NX. Ooh, that's bad already. So G here, that's your government spending. Now taxation, that's impacting our consumption and investment, right? Because how much tax our business pays, how much tax our consumer pays, will also impact our overall after-tax income, and therefore increase or decrease our consumption investment. Okay, so two tools for fiscal policy is either increasing or decreasing government spending directly, or try to use taxation to influence our economic outcome. But both of this will experience something called a multiplier effect and also crowding out effect. So effect, it just means that sometimes when you have an initial change in your government spending or taxation, that will have more than the initial overall impact in the economy. Let me give you an example, right? So let's suppose government says, hey, you know what? Let's say consumer A, we like you. We're gonna give you $100. Well, sounds great. Now, what would that consumer do with $100? They're gonna spend it, right? So that $100 will become, extra consumption in the economy, but that extra consumption will also become income for somebody else in the economy, right? So any initial spending in the economy will cause multiple effect in the economy, and that is called a multiplier effect. And then for the multiplier effect, it follows a very simple formula. Is that your change, your aggregate demand curve equals to the multiplier times the change in initial spending. So how much the initial spending is times multiplier, that equals to your change in the aggregate demand curve. This looks so bad. Aggregate demand curve. And by the way, that's a triangle. I might just rewrite everything. Triangle is called delta, stands for change. Okay, so change in aggregate demand curve equals the multiplier times the change in the initial spending. Now for the multipliers, we have so there's a multiplier on the government spending. There's also a multiplier on tax. So make sure you know which one it is, right? So formula for that. So the multiplier government spending will equals to 1 over 1 minus MPC. And then the multiplier on tax equals to the negative MPC over 1 minus MPC, right? So know which one to use, depends on different fiscal policy, and both of this, you're gonna see them on your quiz for this week, okay? All right, so lastly, the crowding out effect. So whenever the government become a big player in the market, that we're gonna, not by design, but just as a consequence, we're gonna push some other participant out of the market, right? So imagine that, let's suppose you are hungry and you want to, for lunch, you want to buy some chicken fried rice. Well, great, go to the restaurant, buy some chicken fried rice. But what if the government become a very active player in the demand for chicken fried rice? So government buys whole bunch of chicken fried rice. So that higher demand chicken fried rice will push the price higher. So now all of a sudden for you as a consumer, you cannot afford to buy the chicken fried rice anymore. And we call that the crowding out effect. So you're being crowded out of the market. So this has more than just the chicken fried rice. So a lot of times, the crowding out effect actually happening in the interest rate, the money market, right? So because whenever the government try to increase government spending, so higher government spending. Now the problem for that is that even though our U.S. the country, we're the richest country in the world, but U.S. government, we're the poorest government in the world. We don't have the money. So what do? We're gonna borrow it, right? So every time when we try to increase government spending or lower taxes, the government must borrow more money. When they borrow more money, that's increasing money demand, and you're gonna see a higher interest rate. That means some of the consumers who want to borrow money before to buy a car, to buy a house, to pay for a student loan, you couldn't borrow the money anymore because now we have a higher interest rate, and that's called a crowding out effect. So that will reduce our investment spending. All right, so um, so taxes, right? So taxes, this will be on your personal income tax. This is also on the company corporate income tax. And then for this taxes, tax has a very big multiplier effect, because when you reduce taxes or try to increase taxes, that would change our consumption and change our investment greatly. But the change in taxes depends on what kind of tax change that is. So if you have a permanent tax change, so imagine we're going to change our tax code and then reduce our marginal tax rate for the next 10 years, then that will have a big impact on the equity demand curve. And that's we actually did that for the corporate income tax. So I think it was President Trump who did it. So we actually lower our corporate income tax by a lot, and that was a permanent change. So that actually incentivized many of the companies increase investment in America. So that was a big change in our equity demand curve. But if it's only a temporary change, so imagine government says, for next year, everybody getting $10,000. That's too much. Everybody getting $1,000 extra rebate check. Well, that's only temporary change. So what's gonna happen? Then for a lot of consumers, we're gonna save that money, right? That's because we're not sure if the same $1,000 will be happening again year after year after year. So just in case something doesn't happen, we can save the money for the future. But if you expect that this reduction of $1,000 is permanent, then you might do a big behavior change, right? So it depends on whether or not this is a permanent or temporary change that will have an impact on our equity demand curve. All right, so lastly for this chapter, we're going to talk about the stabilization. So we have something called a automatic stabilizing economy. So every time um, we have a shock in the economy, that there are tools we built into the economy that can automatically stabilize the economy. And the reason why we want to stabilize the economy, because any type of shock is bad for the economy. So if you have a positive shock, so the economy is very, very good, well, that might cause inflation in the economy. If there's a negative shock, the economy is going very bad, and that's a recession for the economy. So we don't like those shocks in the economy. So we want to have some policy that's built into the system that will automatically stabilize the economy. For those automatic stabilizers, so we talked about some of this before. So for automatic stabilizers, think about your income tax as an automatic stabilizer. So every time our economy is very, very good, we pay more income tax, right? So that try to reduce our consumption. And then anytime the economy is doing bad, then we pay less income tax. And then another automatic stabilizer is the unemployment insurance, right? So how much that you're getting benefit because you don't have a job anymore, that's also automatically adjusting our overall income. So all this idea goes back to John Bernard Keynes. So the Keynes view of economics, where it says the government should play a very active role in determining and influencing the market outcome in the economy. All right, so last thing I want to talk about for this chapter is this diagram here. Um, Now, it didn't explain too much of it in your textbook. So what this diagram means is that sometimes our fiscal policy can be very, very slow. So there are three timing lag in our fiscal policy. They're called recognition, um, legislative, and also implementation, right? So first, recognition. So it take some time for our government to recognize that there's a problem in the economy. So let's suppose a recession, that it take a couple quarters for our government to realize, hey, there's a recession in the economy. So that's already starting, delay start. And then second, for the legislative delay, that it also takes some time for our government to pass any new law in the Congress to fix the economy, right? So either lower taxes or increase spending, that takes some time to finish, to pass the Congress. That's called legislative effect. And then the last delay, the last lag, is called an implementation. That once your law is passed, that once you're ready to spend the money in the economy, it still takes additional time for that money to fully incorporate into our economy. So the implementation is also very, very slow. So because of the three lag here, that sometimes that between the time you recognize there's a problem to the time that the solution is actually working, there's a big gap in between. And that's the problem for our fiscal policy trying to stabilize the economy. All right, so okay, so we already talked about our automatic stabilizer. So the end for the chapter. So guys, have any question, let me know, and I will see you guys for the next chapter. Okay, see you later. Bye bye.